Hi, I'm Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA report and really kind of break it down into our overview, refined products, and then exports, and try to kind of build into where we think things are going to go over the next couple of weeks. So just to get right to it, we're going to look at the crude stocks, which had a surprise build against estimates, but a little bit less than what was expected from API. Realistically, this is something that's going to be continuous in terms of, a little bit higher builds, a little bit less draws than expected, just because we do have a lot of imports that continue to kind of flow around. But at the same time, we also have a new surge of refined products coming out of China, which we'll talk about in a few minutes. And here you can see that the build overall was about 4.89 million. And you can see this is the time where it's the same versus the SPR, because the SPR, or the Strategic Petroleum Reserve, actually didn't have anything come into it this week. Now, the one thing that's going to be interesting, and it's something that we're going to talk about in our special segment, which will be talking about China, India, the U.S. India and the U.S. are right now looking at having a shared strategic petroleum reserve. So just because the India doesn't have the capacity on their side, they'll be able to rent and utilize some of our capacity that is in the SPR. So it's something interesting in terms of strategic, which we're always going to keep an eye on as India, China continue to kind of heat up. And then the other important part is the crude oil here. So the EIA has the U.S. increasing production by 100,000 barrels. Now, we talked about Alaska increasing, Conoco talked about bringing on another 100,000. We've talked about the Permian coming back, the Bakken coming back. So this makes sense. It's showing up. We're a little bit below where they are. But again, you're starting to see some of this normalization in activity, which, given where refinery activity is and where exports sit, this will weigh against some of those potential draws through the summer months, which we've talked about over the last couple of weeks. Now, really, again, just looking at this versus historics, going back to 1991, you can see that seasonally adjusted, we remain at all-time highs. Typically at this time of year, we get a trend lower. So typically, you have refiners operating at the highest rate possible on a yearly basis, just because they're preparing for the driving season. So this is why, even though it looks like there isn't much movement, if we were to normalize this a bit, you'd see that the trend typically goes down in August as you get draws. But again, we're kind of shaking that off, just given the COVID world we currently sit in. And the pad that we continue to focus on is pad 3. You can see going back to 1991, it's at all-time highs. You had an increase in imports, you had a decrease in refinery runs. So you're starting to see, this, but again, we've plateaued. This is something where we're going to get some draws, we're going to get some surprise builds as we kind of work through the remainder of the summer, where demand just won't be where I think a lot of expectations are, which we've been, very cognizant about and talking about aggressively over the last 6 to 8 weeks. And that's why when we look at imports runs, this is where we were talking about imports increased into pad 3 by 443,000 barrels a day. The interesting thing is we're going to continue to see imports remain relatively elevated into both pad 3, which is the Gulf of Mexico, and pad 5, which is the West Coast. The interesting aspect, which we'll touch on in a few minutes, is going to be imports of refined products into pad 1. As you can see, refinery run rates remain very depressed in pad 1 or the East Coast, and it's because you have refiners that are down. And this is something that's going to continue over the next couple of weeks. We assumed that we were going to be at about 75% refinery run rates on average through the summer. And here you can see that we actually pared back a bit, and it was really driven by pad 1. The pad 3 is going to see, kind of waffle back and forth. Some of this will normalize lower, but you can see year over year, the changes are massive. Typically, last year, we were 15% higher. And again, this is that oil demand that we talk about as we look at refinery utilization rates on a global level, just not demanding the same amount of crude and not running the way they normally do given this time of year. So this is something that's going to kind of remain in this level and then pair off as we go into August. the other issue is going to be implied demand. We've been saying over and over again, and I apologize for the repetitive nature of it, but gasoline demand is just going to be 8.5 million barrels a day. Like we're going to, we'll go up a little bit, we'll go down a little bit, but that's going to be the average. That's going to be the plateau. And then it's going to roll off as we go into the shoulder season or the fall months. Distillate fuel had a big pare back. Again, this is going to be kind of ebbs and flows as we see distillate fuel, increasing. And that's really the implied demand, because this is a calculated number. A lot of this is going to be given based on how much are the refiners producing, how much is actually demanded in the market, and where are exports, which is going to kind of create this net number. And that's why we, when we talk about imports, just to kind of circle back, we need to look at what our PADD 3 imports going to look like. And you can see that they really have come down. You've seen that normalization, and it's really just because we had this huge surge and it came on shore. Now, this is something where, based on what we're seeing in transit, you're going to see this remain above the 5-year average, and we're going to remain at seasonally adjusted all-time highs. But again, it's not going to be like the highs that we saw in September of last year, or that what we saw in June. But again, we're going to see these. It's just timing delays, and these are the kind of the complexities and the issues with some of the EIA data, which is why we use a broad data set to really try to see it's like what's going to happen, and we can see that we're going to get another increase over the next 2 to 3 weeks. And that really brings us to the import number, because the import number is really going to be how is PADD 3 really going to, optimize their throughput from a refining standpoint. And here you can see the imports, going back over the last 5 years. Again, we're going to kind of stay within this range, but it'll remain at the lower end of the 5-year average, just due to the low utilization rates, which is going to weigh on the amount of imports. So even though exports may not be the floating storage may not look crazy, you have to consider, well, where are they running? How are they operating? And that's where you can kind of marry the two, where this is why we're going to continue to see those the storage remain relatively elevated offshore, because the imports kind of have to be timed with how are refiners operating. And just to put the refining capacity in context, you can see where we sit and how that plateau is really kind of worked off, and why we think we're going to remain in this level, especially as we go through the remainder of the summer, and how we look going into the shoulder season. And now we're going to really kind of jump into how does this look across refined products, and why refiners will remain at this level for an extended period of time. Now, as we go through the different products, we have to look at distillate first, only because distillate remains the, that elephant in the room that everyone really kind of talks about. Gasoline really focuses on what's happening in gasoline, but distillate is a big problem here. We had another increase of about 1 million barrels in storage. And when you think about, okay, well, last week we were at all-time highs since 1983. Now we're at all-time highs back to 1982. And you can see that going back through 1991, and just so you know, the data doesn't allow me to go much further back, you can see just how elevated this is and how it's really counter-seasonal. Like typically we build this distillate stock in the fall, because what are we doing? We're preparing for heating season. And now we're going to have this counter-cyclical nature, which is going to, again, keep refinery throughput really depressed. And we just don't have the export market to really offset some of this, which is why you're going to see these refiners continue to operate well below where they normally sit. And when we talk about that product supply, last week we talked about how we were going to just stay within that 5-year average. We'll go a little bit above, a little bit below, but again, we're going to kind of hold that constant. And we see this again today. Like now we're a little bit below, and it's just we're going to sit at this average. And it's good in the sense where it shows that the economy is starting to normalize a bit. You're getting a little bit more of an industrial pull through. Trucking continues to be very robust week over week, month over month, which is a positive to see in terms of moving just stuff around the world, around the country. But again, the bigger consumption point, which is shipping, which is rail, and the shipping remains down about 15% on a global level. Given depending on what route we're talking about, it can be up to 25, 35%. So again, even though we kind of get this normalization because of trucking, because of some industrial use, we're getting that overhang from rail and shipping, which is something that we'll talk about shipping in a little bit more depth later on. But rail is really something where we can see on a year-over-year level, you can see that we continue to remain well off of average, even though we're getting some resurgence in terms of industrial movements. But again, those the new shutdowns, the rollbacks are going to remain an overhang as people adjust spending patterns over the next couple weeks, couple months. And here it's being reflected. And now we had some positives, last week and the week before. But again, as some of these inventories rebuild, you're just going to see these ebbs and flows, and that's going to continue to weigh overall on diesel demand, which is why when we look at grains, that's something that'll increase as we go to harvest. But the ores, metals is going to continue to kind of show that there's going to be these, spits and starts as to, how much steel do we have in inventory? What does pricing look like? So this is going to kind of be that back and forth. But rail is going to continue to be weak, and the problem is 2019 was weak against 2018. So we have 2019 below 2018, and now 2020 below 2019. So you can kind of see the trend is going in the wrong direction, which is something that we're looking at on an overall bigger, more macro level, and it's going to be a bigger overhang. And now jumping into the gasoline story and everybody's favorite topic, we had a smaller than expected draw of gasoline. It was only about we only had a draw of about 1.8 million, and it was really driven by pad 1. And you have to kind of marry that with, well, how come? And you had a refiner go down. You have the lowest utilization rates. I think we're down to about 35, 36% utilization rates on the East Coast, which is going to pull more European products. So imports of gasoline will increase because now we do have some space in the East Coast to kind of open up that arb. So even though this may look pretty good, it's going to be backfilled by imports. And at the same time, you still had a refiner down. And you can see, again, the trend goes, the trend is typically you get draws through the summer because this is the driving season, and we still remain at seasonally adjusted all-time highs going back to 1991. And some of the interesting data that we always look at is when we talk about gas buddy and really what we're seeing on the driving level. So U.S. gasoline demand rose 2.6% yesterday versus last Tuesday. So I know this chart's a little busy and we'll zoom in, but here you can see on the purple line, Sunday to Sunday was down, Monday to Monday, you're starting to see a little bit better. But again, our whole focus has been it's a plateau, and we're seeing that in real time in terms of mobility, in terms of gas buddy, in terms of EIA. It's just we're getting to this point, and that's why some of the quotes here. Monday, gas buddy was down 5.5, about 5% week over week. Monday was down about 2.2% week over week, but Tuesday's gotten a little bit better, and that's that's what we're going to see, this kind of waffling back and forth now that we have some rollbacks in the way people are driving and the reopening of states. And again, this is just really kind of looking at the motor gasoline and the way different things are supplied. So this is the EIA number. It's a calculated number, which we kind of harp on in terms of where imports, exports are. And here you can see we remain well off of where we should be on a seasonally adjusted level, and it's starting to come back. Again, this is the kind of that plateau where we think we're going to kind of average that 8.5 million barrels a day. We're right at about 8.6, but you can see where we were in June, where we are in July, and how we're kind of rolling off as we go into August. And now, the favorite topic on jet fuel, we've seen demand pare back, and this is something that we've talked about. Typically there's that dip, which we saw on the lower end as we go back the last 7 years. And we saw that dip as well. And this is something that we've talked about as we go into August. you have different airlines that have said, look, we're getting back to normal. We're going to normalize a little bit. They're not bringing back as many flights as they said they would in June, just because things change. You had some new shutdowns. You had some delays on reopenings. So now August doesn't need the same amount of jet fuel. But it's still enough, because we have new flights coming, that we're just not going to be at those lows that we've initially seen. We're still going to remain well below the 5-year average, but we're going to be at a new level and a new normal as we go through the remainder of the year. And the reason why is, when we look at TSA passengers, so you can see that kind of plateau. And it's why we've been saying that we were going to be between that 550,000 people to 750,000. And that's where we think we're going to sit really through the remainder of at least the summer. But this is something that we think is going to kind of stay constant as we go through the remainder of the year. We'll probably get a little bit of a trend where, the lows won't be really 550, maybe 650, and move up to 850,000. But again, it's just going to be kind of that range. And you can see versus last year, we're obviously about a little under 2 million people difference between the last year and this year. And that's something that's going to be a continuation through the remainder of the year. And just to look at the mobility data, we can show some of the other ones, like staying at home, not going out. Again, not much has changed, but this is important because the bigger thing that we've seen here is that retail recreation, again, a lot of these things continue to just kind of balance out. And this is where we're seeing that plateau continue to take hold that we saw really from June 9th, based on what we're seeing here through this point. You can kind of see how we've gotten to this level, and we think you're going to get a little bit of a decline, but again, this is that plateau, and we're seeing it again in OPENTABLE. Now, this is looking on a global level. So on a global level, we have where we're really kind of to the side. We continue to see this waffling back and forth, and this is something where we're going to be between let's say 65% and 55% off of normal. And that's going to be something that we're going to remain on a year-over-year level. And again, this is something that we're seeing again on regional breakdown. Like global is at 60%. The U.S. has seen that rollback. We're right now at about 65%, which remains pretty constant. But again, things in Europe have gotten a little bit better. Germany, Ireland, you're starting to see a little bit of a normalization. Australia kind of going to waffle back and forth, which is why we're going to be in this range. But to assume that 60% down globally is going to be continuous, and especially when we consider what this looks like and how driving demand is really going to change as people remain at home. Now, the previous few charts really kind of show how this is a global problem, how there's going to be weight against refined products, not only just in the U.S., but also abroad when we look at mobility, when we look at travel, and OPENTABLE as well, like how many people are going to restaurants. And we'll talk about that in a little bit differently in terms of jobs and what that means in our economy show. But here you can see what's going to happen in terms of exports. So gasoline exports really kind of pared back. But again, it's going to kind of remain within this fixed range now as Latin America starts to try to wake up a little bit coming out of COVID, some reopenings in different areas. And distillate, saw another small increase. And this is something that is going to see pressure, though, going forward. And the pressure is really going to come from China. China has a huge slug of not only refined products sitting in storage, but also because of the new impacts from flooding, some of their rollbacks that they've seen in terms of industrial demand. So they're slating even more oil that's going to, not only just oil, but refined products that is going to get pushed into the market, which will send Middle East refined products, Middle East oil, as well as Indian refined products and South Korean refined products, instead of being absorbed locally, is all going to get pushed into not only just Europe, but also Latin America, which will be a longer term trend and pressure on U.S. exports. So this is something to keep in mind as we kind of go forward and consider this going through the next 6, 8, 12 weeks. Now, one of the things that we talked about was crude oil exports. We thought that they were going to increase. They did by about 450,000 to about 3 million. We think that we're going to kind of see this number hold over the next week or two based on what we've seen. Again, it's going to be a little bit of a timing delay, but this is something where we think we're going to be in this range, give or take 150,000 barrels over the next week to 2 weeks. But we really need to talk about gasoline. And, last week we said how we were going to kind of fall back closer to the 5-year average. And this is where we think we're going to sit over the next 2 to 3 weeks as we have, some additional demand going into some of these Latin American regions. But again, there's also some demand in Pad 1. So you're even going to get local demand kind of competing with some of this export. So this is something where we think that 5-year average is, remains the kind of a key target over the next, 2, 3, 4 weeks. Distillate is the interesting one. We thought we were going to fall a little bit closer to the 5-year average. Instead, we remain in the seasonally adjusted all-time high, or I should say 7-year high, just given, this is where we've been exporting the most. And this is, again, going to be an interesting component going forward because we think this is going to see pressure. But if we start to see pressure from Asia, how do we compete with this? And I think you're going to start to see some of these pricing concessions really come into play as at the very top of the hour where we really talked about this. You can really see it's like we have a ton of distillate just sitting in storage. So you're going to have to see all right, well, if refiners continue to operate, they're going to continue to make products, so they're going to have to make space, which is why we're going to continue to see some of these pricing concessions just to kind of keep the flow going and to compete with some of this eastern product really kind of flowing into the West. So really to kind of wrap up, we like to look at things on a global level. Oil, a lot of there's been talk about, OECD draws, what's happening in the world. And here you can kind of see where we're really kind of leveling off. Japan had a build of crude. The U.S. obviously had a build of oil. So again, we're starting to see kind of this normalization and things kind of slowing out. Fujairah had another draw, which was nice to see. Again, trying to move closer to the 5-year average, still elevated, but again, trending in the right direction. But Japan and the U.S. are continuing to see kind of these adjustments. Japan had a nice draw of distillate, but a big build of oil. The U.S. had a build of oil and distillate. And again, this China move is going to be interesting as we see where their product's going to go. So that's why we're comfortable kind of saying that the trend is going to remain kind of a little bit lower. But again, it's not going to be this huge pace in terms of making up back down to the last 2 years. We're going to kind of remain at this level, and we think that we're going to kind of plateau and find that floor and bounce around for the next week or two. But again, this is when we're supposed to be reducing. So this is going to set up for a bigger problem as we go into shoulder season. Thanks again for watching. Coming up, we're going to have our economy show where we're really going to kind of go through what's happening in the U.S., what's happening abroad, and then we're going to have our favorite conversation on Friday with our primary vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.